Are you tired of everyone overcomplicating ICT concepts? Are you tired of ICT overcomplicating ICT concepts? In this video, I'm going to show you all of the ICT PD arrays and I'm going to show you in less than 10 minutes. Not only that, I'm also going to give you guidelines on how to become profitable and how to become funded using these ICT concepts and ICT PD arrays. So let's get onto the screen. This is going to be done in less than 10 minutes. And I'm so sure that this is going to be so simple, and if you're trying to become profitable with ICT, then this is the video for you. And before we get on the screen, if you guys want a consistent profitable strategy that is very simple, just like I'm going to show you here, then check the first link in the description. The waitlist for the Simple Trading Edge is now open. Let's go onto the screen. So let's talk about all of the ICT PD arrays. One of the things that is very important for you to understand is that ICT PD arrays, they're premium and discount arrays, and they're always one of two: an order block or a fair value gap. Right? So what you can see is that I have divided this into a fair value gap and order blocks. So I'm going to show you all of the different order blocks and all of the different fair value gaps, or just gaps. And then last but not least, we have swing highs and lows. So let's start off with this. Swing highs and lows, they're always an ICT PD array because they are liquidity. So the market is constantly moving from liquidity to liquidity, and swing highs and swing lows are going to be the magnets of price. When the market is bearish, lows are the magnet of price, and when the market is bullish, highs are the magnet of price. So that is all for the ICT swing highs and lows. Now, for fair value gaps, well, we have the standard fair value gap. This shows you what a fair value gap actually is. It's basically a 3-bar pattern where we have a gap in the middle. Then the breakaway gap is basically a fair value gap that has actually finished with a very big impulsive candle. And so this fair value gap is not expected to be traded into because it's a breakaway gap. You normally see that through the third candle of the fair value gap being very, very aggressive. That is normally a breakaway gap. And if you want to trade these, what you have to do is you have to look for a PD array in between this, which is going to be on a lower time frame. Then inverted fair value gaps. Well, the inverted fair value gap is basically when we have a bullish fair value gap that is completely disrespected and is closing the fair value gap, and underneath it, this inverts this bullish fair value gap, and now it becomes a bearish inverted fair value gap. Same thing on the bullish side. If we have a bearish fair value gap, but that fair value gap is flipped back to bullish, then we have a bullish inverted fair value gap. Next one, we have the balanced price range. Balanced price range, or BPR, which is what people like to call it. The BPR is basically two fair value gaps that overlap, creating the BPR. And that can happen on the bullish or on the bearish. Then we have the Reaper. A Reaper is basically a fair value gap that is flipped across and is inside of a breaker order block, which we will look at next. So this you will see is an order block, and this is the fair value gap that is in the discount. So the discount is the 50%. This is underneath. This is the fair value gap that we extend and gives us the Reaper. Then last but not least, in terms of just normal gaps, we have the volume imbalance, which is a gap between the close and the open of a candle. This is what we call a volume imbalance. But this can be applied in different scenarios. So in this case, we can see volume imbalance, market moves up, it's inside of an order block, and that comes in, taps it, and moves up. That is the volume imbalance. But we can apply that on a bigger scale, and that is where the opening gaps come in. So the new day opening gap is when we have a gap between the market opening in one day and the other. This gives us the new day opening gap, and that can act as a bullish or a bearish PD array depending on your overall bias. But basically, a new day opening gap, if there is a difference in price between the market close and market open, that difference is the gap that you draw on. Then we have the opening range gap. The opening range gap applies to indices. Why? Because the market closes and opens, right? And so because of that, when the market opens and when the market closes, since it trades overnight, if there is a difference between where the market traded when the market officially closed and when the market opened, then you have an opening range gap. And we can do that by coming to TradingView, coming down here and changing this to regular trading hours, and this gives you the possible gaps. And for example, as you can see, we had an open gap, we moved down and then moved back up. So next one, we have the new week opening gap, and just like the new day opening gap, the new week is based on weekly candles. If the week opens with a gap, the difference between price when the market closed and when the market opened is the new week opening gap, and we can see that example on euro dollar this week, where the market closed down here, opened up here, and all of this is the new week opening gap, which, as you can see, the market moved up and now just filled it. So that is the new week opening gap. And that is all for gaps. So we have new week, new day, etc. opening gaps. We have normal fair value gaps, etc. Now let's go on to order blocks. We have the breaker block. That means when we have a constant movement and then we shift, this is going to give us the breaker block. This is the first order block. We have the bullish and the bearish. Then we have the mitigation block. The mitigation block is basically when we are on a bearish trend, when there is a bullish counter trend move. Once this bearish trend is confirmed, all this bullish move is going to be considered the mitigation block. So from the low to the high of that counter trend move, that is the mitigation block. And by the way, if you want to get all of this for free, all of this Figma file, just check the second link in the description. It is after the link for the waitlist. So you can get all of this for free, no strings attached. So let's continue. Now, propulsion block. So the propulsion block is basically when we have this reversal, or when we have an order block. It doesn't have to be reversal. We normally have this counter trend move, right? And the propulsion block is basically the extreme of this move, right? So here in this case, we have the reversal, and the propulsion block is the top bullish candle before the move lower. The same thing on the continuation. We have this last down close candle before this move up after tapping the order block. That is the propulsion block. The rejection block is basically when we have the sweep of liquidity and the move up. The extreme, the wick, is going to be our rejection block, both on the bullish and on the bearish. And this is going to tie in very, very well with one thing that I will say at the end. And the reclaimed order blocks are going to appear once we have a shift of momentum. All of the first up close candles on a bearish trend are going to be reclaimed order blocks. So you can see this one is a reclaimed order block. This one is a reclaimed order block. We had this move up. So this was the first candle that did it. This is a reclaimed order block. This is a reclaimed order block, and so on and so forth. The same thing with bearishness, where this is the reclaimed order block. This is the reclaimed order block. This is the reclaimed order block. And now the way that you use these is when the market moves lower. Once it closes below, you can use this as an order block to take this lower. Now, before we exit this video, one thing, if you guys want all of this for free, then make sure to check the second link in the description. It's after the waitlist link. And all of these are just to show you all of the PDOAs that we have. What I'm trying to explain to you is that everything is simple. You can keep it simple. There's no need for you to be like, oh, this is a breaker, this is propulsion, boo, boo. No, it's like, it's either a fair value gap or it's an order block. Keep it simple. You don't need to overcomplicate. Okay? Yes, you can go a little bit deeper into price and understanding what is a fair value gap and what is a breakaway gap, because a breakaway gap is not going to be retested. But at the end of the day, you need to understand that you can keep it as simple as order blocks and fair value gaps. Okay? Everything is just going to be tying in. And if you can identify a very simple order block or a fair value gap, your trading is going to be so much easier. So what I now recommend you guys doing is downloading this sheet, going into the charts and understanding what are the order blocks and what are the fair value gaps that you easily identify. And if you do that, you are very likely to become a consistently profitable trader. So I hope you guys enjoyed. Join the waitlist and download this sheet. Peace.